Welcome back, learners. Today, we're diving headfirst into the layered world of leveraged cryptocurrency trading. It's like it's basically a deep dive into how you execute trades using derivatives and leverage.
Absolutely. It's a complex landscape, but super exciting. So let's kick it off by talking about setting up your trading account. Yep.
Right. The first step is making sure you've separated your derivatives account from the standard spot interface. That's where all the leverage magic happens, you know?
Exactly. It's like having a dedicated playground for advanced trading tools, separate from your regular buying and selling activities.
And it's crucial to fund that derivatives account with USDT. No matter if your assets are in fiat or another cryptocurrency, you got to convert them. It's a small yet essential step that unlocks everything else.
Definitely. Without a funded account, you won't be tapping into that leverage trading potential. Now, let's move on to the different margin modes: isolated, portfolio, and cross margin.
So starting with isolated margin, it's like you allocate a specific amount of funds to one trade. That way, if the trade drops, only that specific chunk is at risk. It's sort of like earmarking funds for one particular battle.
Right, isolated margin is safe in that it limits risk, but it also tightens your liquidation price, which can be unforgiving during turbulent swings.
Exactly. And for beginners or even seasoned traders in choppy markets, that closed liquidation range might not be ideal. It's like if you're too cautious, it can backfire.
Now, when we look at portfolio margin, this approach considers all your open positions together, which generally offers more flexibility. It assesses risk collectively, right?
Yeah, exactly. With portfolio margin, you can offset risk across different trades. But here's the catch. If you mismanage your overall exposure, you might face liquidation, even though each trade individually seems okay.
Yes, I see. That's a great point. It demands a more advanced risk management strategy. And then there's cross margin, which uses your entire derivatives account balance as collateral.
Cross margin is like a double-edged sword. On one hand, it gives you a nice buffer since your whole balance is in play. But on the flip side, a big loss in one trade can impact your entire portfolio.
True, exactly. Speaking of risk management, let's talk leverage itself. Leverage is essentially a multiplier for your buying power. But it's not inherently dangerous. It all comes down to how much of your capital you're risking per trade.
Right. Take, for example, a $1,000 trade with a 1% stop loss. The actual risk stays at $10, whether you're trading with 10x or 100x leverage. It's all about the percentage.
Yes, I agree. Many folks say you should risk no more than 2 to 3% of your total balance per trade. That's basic, but extremely sound advice.
And once you set that risk limit, position sizing comes into play. Most platforms have these long and short position calculators. You mark your entry and stop loss levels, and it tells you exactly how many contracts you should trade.
It's like having a built-in math wizard that ensures you don't accidentally overextend yourself. Now, what about the various order types?
Oh yeah, we start with the market order, which is executed immediately at the best available price. It's fast, but with speed often comes less precision if the market is volatile.
Right. And then we have limit orders, which give you precise control over your price point. You specify exactly where you want to buy or sell, and the order waits for the market to hit that level.
It's like ordering exactly what you want at a fixed price. If the restaurant never offers it, you just keep waiting. But that's the trade-off for precision.
True. Then come conditional orders, often referred to as trigger orders. They only activate once a specific price is reached, which is useful for key support or resistance levels.
Exactly. It's like setting up a trap, only springing into action when the right conditions are met. But here's a thought. Some even debate if these orders add complexity that beginners might not need immediately.
I'd say they're great once you get comfortable with the basics, though. Moving into more advanced territory, we have chase limit orders that adjust to minimize slippage, and TWAP orders, which help you split large trades over time to get an average price.
Yeah, it's like instead of making one giant move, you break it down, so you're not moving the market too much. Then there's also Iceberg orders, where only a portion of the large order is visible.
And scaled orders let you place multiple limit orders at varying price points too. gradually build or reduce your position as market conditions change.
Exactly. It's like slowly sipping your dose rather than taking a big gulp all at once. Now, let's pivot here. What about the methods for entering orders? There's ordering by quantity, by cost, or by value.
Each method integrates well with your risk calculations. Ordering by quantity lets you specify the exact number of contracts. Very helpful when you know your risk from your position sizing tool.
Definitely. And when it comes to exiting, both take profit and stop loss orders can be set as market or limit orders. Market orders ensure immediate exit, while limit orders provide a specific price target, though with the risk of not being executed.
True, exactly. There's also the neat trick of partial take profit and stop loss orders. You can gradually close out parts of your position as the trade moves in your favor.
Yeah, I love that strategy. It's like locking in gains bit by bit while still riding the wave for further profits.
Absolutely, that's a smart move. And speaking of efficiency, we have the post-only setting for limit orders, where your order is added as a maker order to the book. This can help lower fees, very useful over time if you're trading often.
Exactly. Lower fees mean higher net gains, and every little bit adds up. We should also mention time in force settings, like good till canceled, GTC, immediate or cancel, IOC, and fill or kill, FOK, orders. Each serves a different purpose based on how long you expect your order to be active.
Indeed, for sure. Now, let's switch to risk management tools like trailing stops. A trailing stop adjusts automatically as the market moves in your favor, locking in profits while still giving you room to grow.
Right. It's like having a safety net that constantly moves with you. But here, I do want to challenge a bit. Some traders argue that trailing stops might sometimes cut you off too early in choppy markets. What do you think?
I see that point. In volatile conditions, a trailing stop might trigger prematurely. So it's essential to adjust the trailing distance properly based on the market context. It's not foolproof, but it's a highly valuable tool when tuned correctly.
Exactly. It's about finding that sweet spot. Then there are the safety mechanisms on the exchange like auto-deleveraging, ADL, and MMR close. ADL kicks in during extreme market conditions to help maintain stability by reducing positions on the other side.
An MMR close automatically shuts your position when your margin falls below a set threshold, protecting you from catastrophic losses. It's like an insurance policy for your trades.
Beyond that, traders need to become comfortable with chart analysis. Robust charting tools, often integrated via platforms like TradingView, allow you to monitor technical indicators, support and resistance, and overall market sentiment.
Absolutely. Understanding the big picture through charts is like having a roadmap for your trade decisions. And don't forget the funding rate for perpetual futures. It's critical for knowing the cost of maintaining a leveraged position over time.
Right. Fees are another must-watch item. Every trade, transfer, and liquidation can incur fees that over time eat into profitability. Always be aware of your exchange's fee structure.
Exactly. And then there's the psychological part of risk management. Trading success isn't just numbers. It's about keeping your emotions in check, sticking to that 2 to 3% risk per trade rule, and never chasing those huge quick wins.
Totally. It's like trading is a journey. Beginners should experiment with demo accounts to practice strategies before going live. This way, you can learn without risking real money.
Right, for sure. And once you're confident, start with small positions to build your experience gradually. Documenting your trades in a journal is also invaluable. Tracking what works and what doesn't truly refines your strategy over time.
Yes, keeping a trading journal is almost like having a personal mentor. It reinforces those lessons learned from both wins and losses. At the end of the day, consistent learning and disciplined execution are key.
Absolutely. So, to wrap up, while leverage trading is no walk in the park, with its myriad order types, margin modes, and risk management nuances, the core ideas are relatively straightforward once you break them down.
Exactly. It's all about understanding each tool, from isolated, portfolio, and cross-margin to market, limit, and conditional orders. and applying robust risk management strategies so you can trade
Yep.
smartly.
And remember, success in leverage trading doesn't happen overnight. Continuous learning, disciplined risk management, and a steady trading psychology are your best allies.
Thanks for joining this in-depth discussion on leveraged cryptocurrency trading. Stay curious, keep refining your strategies, and always be mindful of the risks. Happy trading, everyone.
Absolutely happy trading.